Now, let's try to look at a few important financial instruments which are playing a very important role in the entire financial markets today. The swaps, very powerful derivative products, options, wide varieties of options available, forwards, very much very highly in demand products, especially when you look at the currency world, when the underlying is currency, or even the interest rates where we talk about the forward rate agreements, and then the swaptions which talk about the options on swaps. So these four different kinds of financial instruments is what we will look at now. Swaps. The word itself is saying the two parties are trying to swap something. So one party gives something to the other in exchange for something else from the other party. But here we have to understand that what is exchanged is purely cash flows, and the exchange happens in future. The dates of exchange are quite known well in advance at the time of entry into the contract itself, and the time period of the swap, which is the duration of the swap or the maturity of the swap, is also known at the outset. So we are talking about exchanging a series of cash flows in the future, and that is what we are calling it as a swap agreement. The mode of calculation, what is the amount that would be exchanged at different points in time, which could be based on one or more market variables, based on the exchange rate at that particular point, or based on the interest rate at that particular point, based on the stock index value at that particular point. So it could be based on one or more market variables. The cash flows are decided, and the dates on which the payments are made, and the duration of the entire set of payments, all of them are decided at the time of agreement itself. So that is in a nutshell a simple swap agreement. And there are good number of swaps today that are available in the market. One, the very common one being the interest rate swap. That's what is called as a plain vanilla swap. And to a large extent, it is issued in the same currency. Now here, the fundamental goes like this. One party, let's say now A and B, have got into an interest rate swap agreement. Right? A and B have got into an interest rate swap agreement. Let's say for a 2-year period and quarterly cash flows. So A and B will exchange the cash flows on a quarterly basis for a 2-year period, which means 8 cash flows are exchanged between each other. And here we are talking about a notional principal. So probably let's call it as $100 million. That is the notional principal. Now this notional, the word is notional is very important because this amount is just for determining the interest rate. It is not exchanged between the parties. So it is not exchanged between the parties. It is used purely for the computation of the interest rate. Now it might so happen that A will pay some fixed rate, let's say 8% on this notional principal every quarter for a 2-year period. Whereas B might say, no, I'll pay a floating rate. And this floating rate could be based on some reference rate. It could be saying that, okay, LIBOR plus 2.5% or 250 basis points. Or it might talk about the the fixed a 2-year fixed deposit rate of a particular bank. Now, some kind of a basis could be used, but that would be the floating interest rate. So, again, on the same notional amount, at the same time periods, for the same duration. So, one party is paying a fixed rate of interest for the entire period, whereas the other party is paying a floating rate of interest which can change every quarter depending on the economic scenario. Now that kind of an instrument is what we are calling as the interest rate swap. Now if I try to look at it like this, okay, now let's do a simple story to understand. A, right? A has borrowed from a bank, right? Let's say A has borrowed some 100 million from a bank, and let's say it is borrowed at 8% fixed rate of interest. But let's say there is something in the mind of A that the interest rates are going to fall in the future, or the interest rates are going to rise in the future. Right? It is expecting that the interest rates are going to rise in the future and it wants to take an advantage of that. Now, what it can do, it can very well get into or probably let's say they are going to fall in future. A is assuming that the interest rates are going to fall in future and it wants to take an advantage of that. Now here, because A has borrowed, its cash outflow is it has to pay at the rate of 8% to the bank. Now it is assuming that the interest rates are going to fall in future, so it wants to take an advantage of that, which means it should surrender the existing loan and actually take a new loan at a lesser interest rate. But it may or may not to do that. There could be a penalty and various other things. Now it will try to find a party B with whom it will say, I'll pay you a floating rate based on the interest rate, but you pay me a fixed rate of 8%. Now let's say on the other side, I'm seeing, let's say B has borrowed from the same bank, probably the same $100 million, but at a floating rate. And now B is worried that the interest rates are going to go up in future. If that's the case, it has to pay a very high interest. So it wants to freeze, it wants to convert that into a fixed rate. Now it has found that A is the counterparty which is asking it to pay 8 and it can receive the floating. Now for A, what has happened? It is receiving 8% from B on 100 million. That 8% it will pay back to the bank. And in a way, it is paying the floating rate to B. Means in a way it has converted the loan. These two are negating each other. In a way it has converted the loan into a floating rate loan. The same logic goes with B as well. It will pay a floating rate to the bank. It will receive the floating rate from A. But it is paying 8% to A. So the floating rate inflow and outflows are negating out each other, cancelling or offsetting each other. So the net is a cash outflow of 8% to A, which means in a way the floating rate loan got converted into a fixed rate loan. The same logic can happen with the assets also, which means swaps per se, they really help to transform the nature of the liabilities and assets. The fixed rate loan can be converted into a floating rate loan and vice versa. The fixed rate asset can be converted into a floating rate asset and vice versa. That is where swaps play a very important role in transforming the nature of the liabilities and the assets. So the banks can really play according to the requirement, balance out between the fixed and the floating assets and the liabilities using the swap transactions in the over-the-counter market. As we know, majority or almost all the swap transactions happen only in the OTC market, right? And when we talk about how these swap deals are executed, generally one of the entities will be a financial institution. Very rarely you find both the sides being non-financial institutions, and even if the non-financial institutions get into a kind of a swap agreement, they generally don't get into a one-on-one kind of direct face-to-face kind of an agreement. They try to coordinate it through a bank which acts as an intermediary, which means it's as good as saying the non-financial institution, there is a bank and another non-financial institution. It looks as if this is a separate contract, this is a separate contract. The bank acts as a counterparty to both the contracts, which means it is working out on two different contracts. And what could very well happen is the gap is whatever is the deal between these two parties, whatever the deal between these two parties, the difference is what? Now, as I said, one party is paying, let's say, 8%, the other party is paying floating rate. Let's say LIBOR plus 2.5%. Now, when an intermediary is coming, it might so happen that the deal will be structured for the same. It might so happen that the intermediary will be taking around, let's say, 0.3%. So overall it might be costing 8.15% on one side and LIBOR plus 2.2% on the other side, or 2.35%. So overall spread is what is coming out, that 0.3%, 0.4% is what is the fee that would be charged by the intermediary, because here it is getting into two different contracts, which means there is a possibility of credit risk that can occur in each of the wings. Either this institution may default or this institution might default. So if there is no default, that 0.3% is the kind of a fee for facilitating this entire transaction, because these two are offsetting kind of transactions. And if there is no default, that spread between them is the fee or is the revenue which the intermediary is getting for taking this transaction forward. But if one of the companies is defaulting, now here is where the important point comes up. In many cases, it might so happen that this entity may not know this entity at all, and it may not even know that this entity is looking for an offsetting transaction, because the deal is only up to here, the non-financial institution with the bank. Another deal is this non-financial institution and the bank. So the other party does not even know that there is an offsetting transaction in the place, right? So if one of the companies is defaulting, this bank is liable to pay even to this other party as well. Now that is where the credit risk comes into picture very heavily, and that is to some extent it is expected that that additional spread that has been charged, the bid ask spread that is being charged, can mitigate the default risk to a certain extent. Now, another important point which comes out with respect to the swap agreement is, okay, there is a non-financial institution 1, there is a non-financial institution 2. These are two non-financial institutions, and here we have a bank which is facilitating this. Now what is generally happening here is this agreement, the bank gets it, but It may not happen. It's very rare that this institution comes to the bank with exactly opposite, equal and opposite kind of a transaction. Practically, I don't think it will be possible. Here, let's say this bank or this non-financial institution wants to enter into a swap as a fixed payer, 8% payment, and it wants to receive the floating rate, let's say based on LIBOR, quarterly payment. Now, this party should come to the same bank saying it wants to pay a floating rate which is LIBOR and receive 8%. Very difficult that for the same amount, two different parties at same point in time will approach the same bank. It's very, very unlikely. So there is some kind of a risk. So it might so happen that the bank will execute this transaction and it may have to wait to execute this particular transaction. So it may have to enter into a swap without having an offsetting swap at all, without having a counterparty who can get into an offsetting swap at all. Now this kind of a situation is called as a warehousing swap. The swap which has been executed with the first party is entered into a warehouse waiting for another counterparty who can get into an equal but exactly opposite kind of a transaction. So those kind of swaps are traditionally called as the warehousing swaps. And when I want to value the interest rate swap, we are simply looking at a long position in one bond. See, if I am talking about an interest rate swap, one party is paying a fixed rate every quarter for 2 years. So it's as if it has issued, look at it like this, it has issued a bond with 8% coupon for a 2-year maturity period, and the coupon is paid quarterly. So this is a short position in the bond. Now, receiving floating, again the same. So it has invested in a floating rate bond for a 2-year maturity where the payments are done quarterly. Now if you look at it, the notional amount of both of them is 100 million because the face value, let's assume that this is the face value. So which means there is a long position in a bond along with a short position, and probably if I am looking at these two, on the maturity the principal is received and paid, so it will negate off each other. But if you look at the others, so there is an interest that is paid, there is an interest that is received. So that is what is the traditional swap. So there is a floating rate interest that is received, fixed rate interest that is paid, or vice versa. Now that is the reason whenever I have to value an interest rate swap, if I really assume that there is no possibility of any default in the future, I can think of it as a long position in one bond, either fixed or floating, and the short position in the other bond. So that is what is going to replicate an interest rate swap quite comfortably. Or in some cases, instead of looking at them in the perspective of bonds, I can look at them as a different forward rate agreements as well. Because in a forward rate agreement, okay, on one side we talk about a fixed and on the other side we talk about a floating rate. For a one single transaction, one party pays a fixed rate, whatever may be the floating rate. So even if the interest rate is 10%, I'll still pay the 8% only. Even if the interest rate is 6%, I'll still pay 8 only. So if you look at it, for whatever the interest rate, the payment is 8% only. So the difference is what is the benefit to the party which is paying the 8%, which is exactly similar to that of a swap. But the only difference is this fixed 8% in a regular FRA, in a regular forward rate agreement, this 8% whatever we are fixing is computed based on the market at that particular point only. But whereas in case of swap, this 8% is fixed for the entire 2 year, the entire duration of the swap, which means that every quarter 8% only is a frozen rate. Whereas when I talk about the FRA, at each quarter, the fixed rate is determined based on the market variables at that particular point, which means how much should be the fixed rate after 3 months, I cannot know until the 3 month period. Whereas in case of swap, it's a fixed 8% altogether. So that's the reason I cannot directly call it as a series of forward rate agreements. We actually use a word called series of off-market FRAs. Means without looking at the market variables at that particular point, we are trying to find out the fixed rate. That is the reason we call them as off-market forward rate agreements. But you can very well value the swap either as a series of bonds, a long position in one bond and a short position in another bond, or you can value them as a series of forward rate agreements. Now, when you look at the interest rate swaps, many other variations also do exist. We talk about, okay, right now the swap, the traditional plain vanilla interest rate swap, which we have looked at, the notional principal remains the same for the entire period of swap. The notional principal is constant. So this is where two more variants come up. If the notional principal keeps reducing every year, every period, that is called as an amortizing swap. But if the notional principal increases every period based on a particular formula, predetermined kind of a mechanism, if the notional principal is constant for the entire duration of the swap, it's a traditional plain vanilla interest rate swap. But if the notional principal comes down, I look at it as an amortizing swap. If the notional principal keeps going up, it is looked at as a step-up swap. And if the traditional swap commences on the day of the agreement itself, whereas in a deferred swap, or sometimes called as a forward swap, the swap does not start on that agreement date itself, but the swap starts at some future date. Probably after 3 months, the swap is going to get initiated. So the swap is not operational for the next 3 months. Only after that, the swap agreement is in place. Or there could be a very interesting instrument called constant maturity swap. In this case, what happens is, in a traditional interest rate swap, the floating rate, generally let's say I'm looking at LIBOR as the floating rate, it's a very short term rate that is being looked at. Whereas in a constant maturity swap, we talk about the floating leg to be of a longer maturity. So if the payments are made quarterly, in a traditional swap, what happens? We talk about, let's say, quarterly payments. The base that is used is a 3-month LIBOR rate. So the LIBOR rate that is used and the frequency of payment, these two generally match. If the payments are semi-annual, I look at a 6-month LIBOR at each period. Whereas in a constant maturity swap, I can still talk about a quarterly payment, but I may use a 5-year LIBOR as the base for a floating rate payment. Now this is what differentiates a traditional interest rate swap from a constant maturity swap. Or a couple of more interesting swaps where there is a scope of an option built into it. extendable swap, where one of the parties, either A or B, they are taking an option to extend the life of a swap. Instead of a 2-year swap, now they have the option to see whether it can get converted into a 3-year or a 5-year maturity kind of a swap. Similarly, when I'm talking about a puttable swap, again one of the two parties might have taken an option to terminate the swap. Right? After 1 year, if it wants to terminate the swap, it can very well terminate it. This is what are the different variants that can exist as a part of the swap instruments. Now, interest rate swaps being one of that very interesting kind of instruments. Apart from interest rate swaps, we also talk about quite a few other variants of swaps, one being the currency swap. Again, the swap fundamental will still remain the same. A and B exchange cash flows at predetermined intervals of time, but instead of an interest rate on a notional principal, here one currency is exchanged for the other, and the principal and the interest payments are happening in one currency, whereas the other party will make the principal and the interest payments in the other currency, which means the principal in both the currencies have to be decided. And in general, okay, if I'm talking about something like this, let's say today $1 is equal to 60 Indian rupees. Now what I'm simply saying is A will make a payment to B in dollars. So A will give $100 to B. Now at that same time, B will give 6,000 Indian rupees to A. It's like a loan. A has given a loan of $100 to B. B has given a loan of 6,000 Indian rupees to A. Now, B will pay the dollar based interest rate. A will pay every quarter for a period of 2 years. B will pay a rupee based interest rate every quarter for a period of 2 years. And at the end of 2 years, A will give back the 6,000 INR to B, and B will give back the $100 back to A. Now these are the transactions. Okay, the day 0. From A's perspective, if I look at, it is paying $100 million, right? And it is receiving 6,000 Indian rupees, or $100 it's paying, 6,000 Indian rupees it is receiving. Every quarter, from A's perspective, now that it has received 6,000, it will pay an interest rate. Let's say the interest rate in India is 8%. So 8% of 6,000, 480 Indian rupees is what it is paying every year. So if it is quarterly, around 120 Indian rupees is paid every quarter. And let's say if the dollar interest rate is 5%. Now on the $100 that it has lent, so 5%, which is $5 per year. So per quarter it is $1.25 is what is received every quarter. And at the end of 2 years, from A's perspective, it is returning back the 6,000 Indian rupees. And it is receiving the $100. Now these are the typical cash flows that happen in a currency swap. Right? Now, during this period, the interest rate, the exchange rate might have changed. Probably it could have gone to 62 rupees a dollar. And here it might have gone to 58 rupees a dollar. So the exchange rate might have changed quite drastically, which means at each point, one party is at a benefit and the other party is at a loss. But on this day, no party is having an explicit benefit or a loss. It is purely computed based on the spot exchange rate. So the principle that is specified in the both currencies, which is more or less equivalent using the exchange rate at the time of the initiation of the swap. And the principal is actually exchanged in the beginning as well as at the end. And these are the cash flows. And what we see in general is, again, this also, just like an interest rate swap, will help the parties to convert the exposures in one kind of a currency into the other. Because let's say A has taken a loan in one currency, but it wants to convert it into another currency. Instead of surrendering the loan and taking a fresh loan, it can use a currency swap where it can receive the payment in that same currency and make the payment in some other currency. So the same currency payment which it is receiving and paying, both of them are offsetting each other, and the net is it is left only with the currency payment with the payment of principal and interest in another currency. So overall it has transformed its loan in one currency to another currency. The same logic happens with respect to the assets as well. And even if you look at this also, it is very much similar to the valuation of this is very much similar to that of an interest rate swap. It's as good as I'm taking a long position in a bond in one currency and taking a short position in another bond in another currency. So overall it is valued again as a combination of the bonds itself, but the exchange rate movements also will play an important role in the valuation of the currency swap. Now moving a little bit more further, looking at the total return swap. These kind of swaps are something where one party wants to pay the return on some asset. It could be equity, it could be index, whatever. One party is paying a return on one asset and the other party is paying some kind of a floating rate or a fixed rate, whatever it is. So one party is making a floating or a fixed payment, whereas the other party is paying a return on some reference asset. Now this can happen across different kinds of equities, credit, interest rate, currency, commodity, any kind of asset can be included as a part of this total return swaps. And today there are even more different varieties of swaps, wherein some index, the return on the index is being paid and a fixed rate of return is obtained, is received. So swapping the fixed return for an index return, I can use some index. I don't need to use a stock index. I don't need to use a bond index. I can use a property index. I can use a retail price index. I can use a limited price index, whatever it is. Or I can talk about a cross currency swap, right? Fixed rate in one currency, floating rate in the other currency. So it's a combination of both interest rate swap as well as the exchange rate. Or I can look at a dividend swap. The dividend received on one single asset or a series of equity stocks. The dividend received on that series of equity securities is exchanged for a fixed rate of return. That's also a kind of a swap. Or we can talk about the variance swaps, volatility swaps. A fixed volatility will be decided. Let's say 20% is the fixed volatility. Now during the period the volatility will be computed. Okay, if the volatility during a particular period is 25%, the 5% on some notional principal will be made as a payment to the other party. But whereas if the volatility during the period is only 15%, 5% will be received from the other. So it is as good as exchanging a fixed rate of return for the experienced volatility associated with respect to the actual volatility. Now these are the various kinds of swap instruments that are available in the market, and all of them are helpful, one for hedging purposes, where the financial institutions can try to balance their volatility levels, the returns which they are getting. They have a hold in terms of manipulating those numbers. Along with, they can play a speculative game in terms of getting a benefit based on the way they expect the movement of that to occur in the future. Now that we know the swap, one more instrument which is worth understanding very heavily is the swaption. Definition wise, it is nothing but option on a swap. As the word itself is saying, whether to get into a swap or not, the party can really have an option. One party to the contract is having an option to decide whether it wants to get into a swap in future or not. If it wants to get into the swap, yes, it can. But if it does not want to get into the swap, it can back out. The other party cannot have any kind of a right if this particular party backs out of the swap agreement. So just like any other definition of an option, one party is having a right to enter into a swap at a certain time in the future. So it is as good as, okay, if at all I have to enter, I'll enter into the swap by paying up 6%. Now you see, I will decide at that point in time, it's as good as like this. Okay, I want a loan, right? A company wants a loan, and not now, after 1 year. After 1 year, it wants a loan. Now, and that typical loan, it wants it for a 3-year period. From that one, means between 1 year to 4 years, it wants to go for the loan. Now, it wants to decide, it wants to freeze on that interest rate. So it wants to pay only an 8% interest rate. But if it has to get into the loan after 1 year, whatever is the interest rate that is prevailing at that particular point in time would be the interest rate for this 3-year loan. But it wants to lock that. So in that case, what can very well happen is, it can get into an option saying it would be ready to pay 8% as the interest rate after 1 year. Now, if the market rate is much lesser than that, it can simply expire the contract. But if the market interest rate is much higher than that, it can very well go ahead with this contract. Now, it can very well decide whether to go ahead with the contract at a future date or not. Now, that is where we are calling as a swaption. The swap agreement, to pay something, the rate what has to be paid is decided today itself. But whether it wants to get into it with that kind of a payoff, it can decide after 1 year. So it can actually guarantee that fixed rate. Okay, it will be 8% or less at a future date. So whatever the loan they are going to pay, it can very well freeze on the interest rate that can be applicable at that particular point. It cannot go beyond 8% in this particular situation. So the locking of the interest rate can quite comfortably be done with this swaption kind of an agreement. So the company will be able to get an advantage, take the advantage with respect to the interest rate movement that are going in favor of the company. Whereas if the interest rate movements are happening completely in an opposite direction, unfavorable kind of a direction, it can very well back out from the contract because there is an option behavior that is there in that particular contract. So the insurers can very well use this, especially if they are planning to offer the fixed rate product to a particular policy holder. Swaptions wise, there are 3 major categories, just like any option. When I am talking about European, I'll talk about entering into a swap at a fixed rate, at a strike rate, on one single date in future, whatever is the expiry date of the option. Whereas when I talk about the American, so it's say, if I say I've got into a 1 year swaption. At the end of 1 year, so it is like this: 1 year swaption for a 3-year swap. So it means from today to 1 year, the swaption will work, and 1 year to 4th year, the swap will work. Now this is the expiry of the swaption. When I talk about getting into a swap here, it is called as a European swaption. When I talk about getting into a swap, deciding on whether I want to move ahead with the swap or not, at any point in time in this entire period, it is called as the American swaption. Whereas if I am deciding at predetermined intervals of time, let's say after every month, I have the point of deciding whether I should go ahead with the swap or not. Multiple fixed dates. It's not any time between now and the next 1 year, but multiple fixed dates, just let's say at the end of every month. Then we are calling it as a Bermudan swaption. So these are the 3 different kinds of swaptions that are there. Just like the options, even in the option world, these 3 kinds of options exist. The same thing goes with respect to the swaptions as well. Now, another important thing that plays an important role here, options. We have already talked about the swaption, which uses the concept of option very heavily, right? Or I can, if I can visualize the swaption as option to exchange a fixed rate bond. One party is giving a fixed rate bond for the principal amount of the swap. One party is giving a fixed rate bond for the principal amount of the swap. So it's a put option in case of paying fixed. So it's exchanging of the put option and receiving, when we are talking of paying fixed and receiving floating, we are calling it as a put option. Whereas when we are talking of paying floating and receiving fixed, it is as good as a call option itself. Right? A fixed rate bond is being exchanged for the principal amount of the swap. Or I can have the option to talk about buying or selling a particular bond by a certain particular date, because we have talked about earlier embedded call options or callable bond or a puttable bond, which is more similar to a conventional bond plus an embedded option that is packaged into it. So which can very well facilitate early redemption of the bond. If I am talking about a puttable bond, I can sell off the bond at any point before the maturity of the bond. If I'm talking of a callable bond, the issuer can buy back the bond at any time before the maturity of the bond. So in the bond world, in the traditional fixed income world, I could see the usage of the bonds packaged with the embedded options to create even more interesting financial instrument. The same option kind of provision can come even into the loans world, especially called as the prepayments associated with the loans and the mortgages. They also have a similar kind of option-like behavior. And the same way I can look at forwards, which are very, very popular with respect to the currencies, where I talk about buying or selling an asset at a certain future time at for a particular price which has been decided right now itself, which play a very important role in hedging the foreign exchange risk or the currency risk. Forward rate agreement I have already talked about, wherein one party will freeze the interest rate that is going to pay to the other, irrespective of the prevailing interest rates in the market during a specified period. So that's the reason we can call interest rate swap as a portfolio of forward rate agreements, where the forward rate would be a fix for the entire duration of the swap. But here we have to understand, when I am talking about a simple swap, we talk about it is the fixed rate is decided in such a way that for the entire period, if I look at the present value of the fixed payments versus the floating payments, as of today, the zero as of the day of initiation of the contract, the value is 0. But that doesn't mean, when I'm looking at it from a forward rate agreements perspective, the present value of all the forward rate agreements will not sum up to 0, because we are looking at them as an off-market. Swap is not exactly a portfolio of forward rate agreement. Swap is a portfolio of off-market forward rate agreements. So we have to understand these different kinds of instruments which play a very important role in terms of hedging, speculation, in terms of the companies being able to manage their portfolios quite effectively. So this is where in this session my focus was more on 4 different such kind of instruments, different kinds of swaps, different swaptions, the options as well as the forwards, right?